After freshman year, a bunch of guys and a bunch of women on campus, they get together and they decide to save some money and move into a house. So it's 3 guys maybe and 3 young women. And none of these guys and women are dating. And maybe 6, 7 weeks into the semester, it's 2 in the morning, and one of the guys is walking around the hall there. He taps on the door of one of the young women, and she comes. He says, "Oh, I can't get in my room. I think my roommate's in there. He's locked the door. I think he's with his girlfriend. I can't get in. I got to get some sleep. I got a chem test at 8 in the morning. What am I going to do?" She says, "Oh, geez, I don't know. He says, "Geez, I got a chem test, man. It's really important." And she says, "Well, you can come sleep in here for the night." And he says, "Oh, no, I don't want to do that. She says, "Oh, sure, come on, it's okay." And then he says, "All right." And then 15 minutes later, the 2 of them are having sex. Now, she probably didn't want to have sex with this guy, but nonetheless, she did. Now, I say, what does that have in common with this textbook here, a macro textbook, or this textbook here, another macro textbook? What do those 2 things have in common? I'll tell you what both of those things have in common. They're both about a trick. They're both about a tricking. Macroeconomics, I assert, the way we teach it, the way we have it in textbooks, the way we talk about it in the public, and the way it's supposed to work, is all about tricking people. It's about tricking lenders into making loans they weren't intending to make. It's about tricking workers into working when they weren't intending to work. It's about tricking businesses into doing enterprise or doing production they weren't intending to do. It is all very, very much about a trick. Both fiscal policy and monetary policy are all about tricks. Microeconomics, in contrast, is not about tricking. Macroeconomics is a science, I repeat, all about tricking. Go back to 1982. I'm taking a course at Boston College, my senior year, a macroeconomics course, topics in macroeconomics, taught by a guy named Arthur Rolnick. One day he goes up in front of the class, he says, "Well, those Keynesian models, they're all, quote, trick the worker models." Now I'm sitting there saying, "What do you mean? What do you mean?" But then, as I thought about it, and as I taught the course over and over again, I realized that indeed, macroeconomics, the way we talk about it in text, and the way we think about it, and the way it's supposed to work, is all about tricking. It's a kind of tricking I don't think works in a microeconomic world, and it's a kind of tricking I think we have to get away from. So before I get to how macroeconomic theory is all based on tricks, let me just talk about tricks in the real world. Are we a society full of pathetic victims of endless tricking? Well, you know, if you go to a magic show, the magician tries to trick you. He's doing something in one hand while he's moving something in another hand. He distracts you. And, you know, in mystery fiction, they give you hidden clues, and you're not supposed to pick up on them unless you're smart. They try to trick you, lead you the other way. Even in regular fiction, they bury all kinds of hidden messages and symbols and names and so on. Seems kind of camp, but that's the way they do it, all designed to kind of trick you. And you know how the cop tries to trick you. The cop just doesn't come up to you and say, "Mr. McHugh, even though you were at a card game where there were 5 witnesses, I suspect that you were the one who killed your wife." He says he asked me a bunch of questions to try to trick me into saying something that proves that I designed the murder of my wife. The military is a great tricker. I read a story about a soldier in Iraq who's got a great kill count of Iraqis, yet he's denouncing the war now, and he says he was tricked by the military, that the recruiter told him that being in the military would be like Club Med. So he was tricked into joining the military, but then when he got to Iraq, he was not tricked by the Iraqis. As I said, he had a nice kill count. And of course, let's look at some economic things. We all know how the supermarket tries to trick us. They put the milk at the back of the store, so you'll walk all the way down, and you went there just for a gallon of milk, and you come out buying all kinds of things. And we know, of course, the big corporations are tricking us all the time. Walmart has tricked us. The tobacco companies have tricked us into smoking. McDonald's tricked us by supersizing the meals. General Motors and the car companies, they tricked us. We never wanted those big cars. We only wanted cars that would get us from point A to point B. But General Motors tricked us into buying those gigantic pickup trucks and those gigantic SUVs. And we see tricking when we do transactions ourselves. The real estate agent tells me to paint the house, and then we'll be able to jack up the price of the house a lot. I say, well, it's a $10,000 job to paint the house. He says, but don't worry. The people who come to buy, they'll see such a fresh new house that they'll be willing to pay $25,000 more. I'm suspicious. I say, you know, if I went to a house and I was buying a house that looked to me like it was just painted, it wouldn't fool me. But he says, no, go ahead and paint the house. I suspect there is a trick going on here. The real estate agent's trying to get me to paint the house so he can move the house more quickly. And then one more example, a big example. Let's talk about great economist Paul Krugman. You know, he says that the people of America have been tricked. That under the Bush administration for 8 years, we've been tricked into believing tax cuts. But wait, it's a lot worse than that. It's not just the last 8 years. It's been 30 years the right wing has tricked the people of America, into believing all kinds of right-wing economic doctrines. We haven't been able to see through it. We haven't been able to find the truth. So that's the kind of tricking you see out there in the real world. It's omnipresent. Does it work? I don't think it does at all, but maybe some people do. Now let's talk about why does tricking appear in macroeconomics? A standard monetary policy is indeed a trick. Now what I mean by standard monetary policy is the doing of open market operations, the buying and selling of bonds held by banks, by our central bank, to affect the Fed funds rate. So we say we want to stimulate the economy, we lower a Fed funds target rate, then we stand ready to buy and sell bonds in banks to get the Fed funds rate, the rate that banks lend to each other at, lower. And then that, through the transmission mechanism, supposedly spreads out to the greater economy, the car loan rates and so on. Now, you might say, that hasn't been done a lot in 2008. In fact, we tried to do it and it didn't work. That's why we've been doing all kinds of other more innovative monetary policy in 2008. It's been the year of special lending. We've been doing hundreds of billions of dollars of special lending to banks. We've been doing that same kind of lending in the commercial paper market. We've been supporting companies like Bear Stearns and EIG and so on. The year 2008 was not a good year for regular monetary policy. But given that, the 20 years before that was all open market operations to affect the Fed funds rate. And I'll explain to you why that's just a big trick. In standard monetary policy, the key thing is the central bank can lower the real rate. That's the key thing, that they can lower the real rate, the rate that I'm really going to make on the money I'm lending. Think about a bank. A bank gives you a mortgage at about 6%. The bank thinks that inflation, that's this pi with the superscript E, pi expected is going to be about 3%. That inflation in the future is going to be about 3%. So I lend to you, I'm the bank, at about 6% because I want to make a real rate of return of 3%. Given your security and your credit history and so on, I'm willing to take a real 3%. And if it's going to be higher than 3%, other bankers will come into the business and they'll lower the rate of return to about 3%. But if it's going to be lower than 3%, it's a no-go. I don't want to do that kind of lending. So how does the trick come in? Well, the Fed goes ahead and it lowers the target Fed funds rate. And then let's say it does sufficient open market operations to get that Fed funds rate down. So that's the rate that banks lend to each other at. Now that rate might not affect the mortgage rate directly, but supposedly it will affect things like short-term treasury rates and other short-term rates. And then that will bubble forth in what we call a transmission mechanism to the entire economy. And it will lower the rates throughout the entire economy, car loan rates and mortgage rates and so on. So if the Fed lowers the target funds rate by about 1%, given some lag, you can expect that the mortgage rate, the nominal mortgage rate, that is, the rate that I'll actually charge you, should go down maybe about 1%. Now there's where the trick comes in. I don't really want to lend to you at 5% if I think inflation is going to be 3%. The last piece is that inflation is slow to change. Whether that's true or not is also dubious. How we form up these expectations of inflation is also an issue. But in general, the whole idea, the whole hallmark of monetary policy is that the Fed can lower the real rate. The Fed can make me, a bank, lend to you at a real rate of 2%, which I was never intending to lend to you at. Without that, the policy should not work. The fiscal policy is also a trick the people type of parable. You talk about trick the workers into working, trick the consumers, the taxpayers. So the economy isn't running that well. GDP isn't growing as much as we think it should grow. So the government goes out, either cuts taxes or increases government spending. How do they get the money for the taxes, the tax cuts, and the government spending? They borrow money. Now that's not supposed to be observed by people. We don't realize that our government's borrowing from us, so we're going to have to pay it back later. We just get the tax cut, then we go out and spend it. In fact, we had a tax cut recently. People didn't spend it. The government was nonplussed. We're trying to figure out what kind of tax cut can we design now that people will spend. How can we trick the people who are easily tricked into spending? They talk about increasing government spending. It's the same story. Where does the money come from? Then we go out and say to the factories, make these products. They weren't intending to make these products in the economy before. But the whole idea is that, if we just get them up and running, it will have such spillover effects that all the money that we spent on the tax cuts and government spending will be recouped further in the future. Do you believe this to be a valid parable? So macro, in my opinion, is all tricks. Do you think the trillions of dollars of macro stimulus we're doing now are going to trick people into making more stuff that we really want? Micro is generally no tricks. Now, the example I used at the start of this video about the unfortunate young woman, that was indeed a micro tricking. Watch your micro tricks. Now, here's a question, a teaser question. You fill in the blanks. Do you think the Chinese